All right, everyone. Altria reported their earnings today and had a bit of a dip, even though their stock prices run up a good bit recently, thanks in part to aggressive share buybacks in the most recent quarter. Now, it's a bit of a disappointment on the one hand, having missed revenue and EPS estimates. I've read some articles that said, in spite of this, that at least there's still some good signs from the smokeless nicotine options that they offer. This would include things like oral pouches, and perhaps you could throw vaping in there as well. Of course, there are high hopes for the Enjoy vaping platform that they acquired and have been distributing, though surely we have not yet seen the full fruits of those investments yet. But smoking, on the whole, is definitely on the decline. When you track their revenue over the last few years, you see that there've been a couple standout quarters here, but overall, it really doesn't look like it's gone anywhere. And this is because every time the number of smokers declines, they respond with increasing prices, which works due to the addictive nature of the product. And also, of course, they increase the number of SKUs, products in their lineup to include more things like oral nicotine and, of course, vaping platforms. But it's a challenge to capture that vaping market, because there are also a lot of knockoff type products out there which don't necessarily follow all of the same rules and guidelines. They kind of are fly-by-night type operations, and in some cases outright violate the IP of existing brands. And it's just a difficult situation to navigate, a war on multiple fronts, you might say. It does seem like part of their strategy now would be to drive up EPS and free cash flow per share through aggressive buybacks. This, of course, helps when the stock price is cheap, as it has been recently. They do spend most of their adjusted earnings, roughly 80%, on the dividend, but a lot of what's left, it seems that they want to pile into buybacks. They also put a lot of the proceeds from selling off some of their Anheuser-Busch InBev stake into these buybacks. And over time, this will have sort of a compounding effect and drive up EPS, assuming that revenues don't absolutely collapse in the meanwhile. When we take a look at valuation multiples, their PE is a mere 10, with price to free cash flow and price to operating cash flow being very close to 9 each, respectively. Now, compare this to some of the bigger mega caps that I was looking at in the tech sector, where a price to operating cash flow near 20 was looking kind of attractive to me. This is the difference between a business with a lot of growing prospects and a big runway ahead into the future, and one that's probably seen its better days and from which we can't really expect all that much in terms of growth going forward. I think these price levels, these 9 times free cash flow, 10 PE, might actually be kind of reasonable for a company with the prospects that Altria has going forward, simply because you're not really going to get a huge boost in your sales on a company like this. So you have to get your piece of the business for cheap, basically, in order for it to end up playing out and being worth it in the long run. Analysts are pretty neutral with a hold rating. We have a high side of 56, which that's kind of in line with some of the higher prices they've reached before. I think they may have been as high as 60 at one point, but certainly mid 50s up to maybe 60 is probably a reasonable top for this name if everything went really well for a little while. I could see a run up to that point. They have a 36 low target, which, granted, that seems pretty pretty pessimistic, but if they can't find a way to drive EPS up going forward, I could definitely see where it could eventually hit there if perhaps they have another disappointing quarter this year. Definitely wouldn't necessarily rule that out. So, like, I don't think the analysts on their price targets are at any point completely out of line. It just depends on whether they're somewhat optimistic or somewhat pessimistic. The more optimistic ones think it could go up maybe 10-12% from here. The pessimistic ones think, it could drop by as much as 20%. So, and I could see both sides of that story. Many investors, of course, buy into Altria for the attractive yield. The yield on cost today in terms of the dividend is 8%. Mine's a little bit higher. I think just above 9% because I got in quite a lot cheaper and there was a dividend bump in the meanwhile. Also, there's been a buyback yield of 1.24%, which may end up higher because I know they have stepped the gas on the buybacks recently. And this combined results in a shareholder yield combined of 9.48%. That is definitely more than what you get in the general market. And for investors that are just looking for a consumer staple that just gives them capital return through direct yield and through buybacks, this would be definitely one of those names that delivers on those fronts anyway, if not the price appreciation and the growth in the underlying business. But the question is it actually worth it compared to what they produce? So when I look at what they need to do to justify today's valuation, first of all, we'll go with the standard 10% discount rate, and we'll knock off their net debt off of here. So they're getting a deduction for that. We're assigning them a growth rate of 5% for their free cash flow, going down to 4%. The 5% is sort of, hey, if Enjoy starts to kind of take off and be accretive, maybe they can grow it by that much annually over a period of years, then maybe it drops back to a 4%. I think maybe just barely beating out inflation in the long run makes sense if things go reasonably well for them. Things could go better than expected, sure, and maybe they get 7% growth instead of 5% or something like that. Maybe there's a comeback in cigarettes and they're seen as cool again. Like, there's things that wouldn't necessarily violate the laws of the universe that could be tailwinds for Altria, but I'm trying to be somewhat neutral here and say, what do they have to do to justify today's price that is somewhat realistic? And I think Enjoy goes okay. Smoking rates at least somewhat kind of level out. The decline maybe slows a little bit. And, you're left with today's price basically in that scenario. However, I think when you also, run the more bearish case of what if it's like stagnant or only grows at like 2%, then the value honestly plummets on what it's worth. And then, of course, you have to ask yourself, is it more likely that the bad thing happens, or that the kind of good thing happens, or the really good thing happens? So that's kind of what I'm thinking of. I am still at a pretty decent little gain on this, price-wise, plus dividends collected over time. So I'm kind of faced with a decision here of what I want to do with my position now going forward. And this is just one of those things I'm revisiting. Let me know in the comments below if you have Altria and what if you're thinking about selling here, or if there is a price that you would exit at. I want to know. Also, just, tell me what you think you would do in my shoes. I have 200 shares at the current thing. My cost basis, I believe, is right in the neighborhood of 44 per share. Also, be sure to like the video for the algorithm, subscribe to help me grow my audience, join my Discord, link in the description. We do discuss stocks like Altria all the time. We do have some tobacco and nicotine bulls in the Discord that you could share your thoughts with. Make sure that you also follow me on Twitter or X at Mr. Macho Mog. This is very important. And catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live. Not enough people are doing this. And as always, take it easy, everyone.